Vikas Khemani. Vikas Khemani, founder and CIO at Carnelian Asset Management and Advisors.
The fact that you began your journey in the stock markets at a time when things were very different, the Harshad Mehta time, and we did see that IPO boom. You have admitted to have even lost your father's money. Can you tell us a little bit more about that?
I invested a lot of years before I could even take a serious.
You're saying crisis is the time to invest.
Because good price and good news don't come together.
Isn't it worrying the kind of numbers that we're seeing?
Post-COVID, emerging markets were losing money, but India was benefiting.
Hello everyone and welcome to Wealth by Motilal Oswal. I'm Avan Dabash. So what does your checklist look like, Vikas?
Competence, integrity and drive.
No matter what is happening all over the world and in the country, your headline says
Crises are the always opportunity to invest. No matter what you tell them, they will see you and learn from you.
But it's been a long time since banks have actually done well.
I don't know, I think most banks have done well.
The Prime Minister has said now,
हम सोने की खरीद को टालें, पेट्रोल डीजल का उपयोग कम करें, विदेशी सामान की जगह लोकल उत्पादों को अपनाएं.
Probably it is a little bit of misunderstood thing.
there is this fear of the world order now changing completely, moving from the US to China. Hello everyone and welcome to Wealth by Motilal Oswal. I'm Avan Dabash. My guest today started reading the Economic Times every day, not because he was told to, but because he wanted to understand the world. English was something he taught himself, and the stock markets, a puzzle that he became obsessed with. Over the years, he's built the reputation of spotting opportunity early and remaining constructive on the India story. Whether it's backing ICICI Bank when sentiment was at the lowest, or identifying the manufacturing space and engineering space before it entered the market's radar. At a time when global uncertainties are dominating the market narrative, we have FIIs pulling out, markets in correction mode, war as a headline. We sit down and talk to Vikas about what his outlook is to best navigate the market volatility, which sectors he finds the most promising, the missed opportunities, as well as what money means to him, and how emotional behaviors also play a big role in managing money. Let's get started. Vikas, welcome. Thank you so much for joining in. I was doing some research about you and what you've been saying of late, and it's amazing. No matter what is happening all over the world and in the country, your headline says India's investment case remains strong. I wonder what's driving this conviction in light of the fact that the Prime Minister has said now curb travel, be cautious, global headlines, the war with Iran. What's driving the conviction?
So first of all, thank you for having me. So I think probably it is a little bit of misunderstood thing. Structurally I'm very positive on India. Very often when I say I am bullish. Of course, I am very bullish. I am generally very optimist on India as a structural story. In a long-term structural story, there are always going to be short-term bumps, speed bumps, or challenges. But those challenges should not move your conviction away. Very often what happens is people see a very short-term thing and start writing as a long-term outlook. So at least I don't let that happen to me. That does not mean that you deny or the short-term challenges. Of course, what India is facing, I have said in multiple forums that post the January, February, India was looking very good, and post-war, India is definitely vulnerable on many counts, especially on the forex counts. India has got hit by three big, I call triple whammies on the forex in last 12 months specifically. One is on gold. India imports about 700 tons of gold every year. That quantity is not going down, but the price has gone up.
Yeah.
So that has hit, it was $70-80 billion of import, has gone up by $50-60 billion, right? So that number, of course, puts pressure on the current account. Semiconductor chips, India imports about $70-80 billion. That number, cost of that chips have gone up between 50% to 250% over, depending on which we are talking about. That is again puts strain on the current account deficit by 50-60%, or $50-60 billion. And third is oil, which was the last due to oil, Iran war. Oil prices have gone up 130, 140 depending on when you're buying. So that is again hit by another $40-50 billion. So in general, you have had about $150 billion of impact on current account deficit in a very short period of time. And that has led to stress, and we need to deal with it. And doesn't look like even oil might come down, but rest of the two unlikely to come down in a hurry. So I think it will be a little bit of a stretched, current account deficit scenario, and I'm sure it will have an implication. But most important worrisome part is the oil one, because that can have an inflationary impact.
So given that you've brought up the fact that we are very vulnerable on all of these factors, you're saying deal with it. What is deal with it? What does the average investor do at this point? Because your tendency is to panic sell right now rather than look for opportunity. What are you advising an investor?
So I think crises are the always opportunity to invest, provided you understand what you believe in the long term, right? Let's go back to very similar situation in 2022 when the Ukraine war broke out. 22 started on a very good note, but I think February or March when Ukraine war broke out, initial reaction was it will get over fast, and then it prolonged. Oil prices went up, supply chain got broke down, and because of that, by the time July, August came, pretty much everybody was in bearish camp. Mid caps were down 30, 40, 50%, very similar to this kind of current environment, right? And I remember writing a note, letters to our investors at that time, saying build this vintage, because good price and good news don't come together. Only when the bad news come, you get good prices, right? But you can do that only provided you know that this crisis is not going to break Indian economy forever.
Yeah.
It's a temporary phase, it's a passing phase. So I do believe that the current situation is pretty much similar to that of 2022, that it is a passing phase. It is not a good phase. It is a painful phase for everybody, not only as an investor, even people who do business. Think about it. People who are doing businesses, they don't know about their raw material, security, price, when they will come. Supply chains are disrupted. Energy is not, sure. When if you make goods, how will you dispatch?
Yeah.
Recovering of money, everything's gone for uncertain situation. So I think everybody is paying price for this difficult situation globally. Now.
But you're saying crisis is the time to invest.
Crisis time to invest, and we all know that this is not breaking Indian economy. It is exposed our vulnerability, but it is not that we have handled even bigger crises than this in the past. Good news is that equilibrium gets found, because today with the rupee being where it is, suddenly your export becomes far more competitive, so that starts becoming more attractive. Those businesses start doing well. So the way we at least approach is that invest into businesses which benefit out of this crisis, or which are unaffected by this crisis, or will come out stronger out of this crisis, rather than running away from the market by being scared. Assess with a calm mind and see how can I on the other side of the crisis come out very well and be far more better placed than I was before the crisis.
Okay, so it is a temporary phase and this is an opportunity, and you're saying sectors or companies that will benefit from the crisis or not be that affected. Which are those?
So let's say for example, we have very large exposure to pharma, CDMO, healthcare space. Now that doesn't get impacted with whatever is happening right now, right? In fact, some of the companies we've been buying more and more.
Yeah.
It's another sector which temporarily, and that you're seeing in the prices, the BFSI. Now we know that Indian economy is not crippled forever. You're getting good prices in the stocks because of the temporary spike in the yield. Once the issue settles down, that yield will come down and banks will do well. Same thing happened in 22. That banks got sold off, and 23 banks were the very good winner.
But it's been a long time since banks have actually done well, even some of the large blue chip names, right? So do we still just remain patient?
I don't know. I think most banks have done well. ICICI Bank is up 5x in last 5-6 years. Axis Bank is up, I think, 4x.
But if we're just looking at the last 1 to 2 years?
Yes, last 1 year has been a challenging year because of this whole spike in the yield and compression on the NIM, basically. That has led to, but the credit growth has picked up, right? So if you see credit growth is doing well, but the margin compression happened because of this situation.
Yeah.
That's the reason you are getting, stock prices not doing well or corrected, right? But when that changes, those same stocks will do well.
Okay.
So that's where the opportunity lies, right? If you can see what will likely to happen on the other side of the crisis, if you can imagine, if you can do that modeling,
Yeah.
then you will be able to envisage the price rise also.
Okay, fair enough. And these are some of the sectors: pharma, CDMO, health, and BFSI. What about this FII exodus? Something like 2 lakh crores in 2026 alone. And if we compare it to 2025, that was about 2.4 lakh crores in the secondary market, the sell-off. Isn't it worrying, the kind of numbers that we're seeing? Are we seeing this flow now, capital increasingly shift to the other Asian economies?
So I think India is part of emerging market basket. In general, whenever emerging market receives money, we do receive, and whenever emerging markets do receive outflow, we lose money. Post-COVID, India was very promising. In 21-22, India received disproportionately large overweight of emerging market. That time also, when the Fed rate was going up, emerging markets were losing money, but India was benefiting. And post that, emerging market has not started receiving money, but when the China and other countries have started doing well, money has shifted away or moved away from India to other emerging markets. So another way to understand is that how a fund manager does underweight, overweight across sectors. That is how emerging market fund manager does underweight, overweight across countries. So I think that happened pretty much in 2025 and some part of 26. So my sense is that we are by and large behind it, but who knows. Good news is that we have a good domestic flows coming through the market,
Yes.
which has kind of given very good cushion. And FI money will come back for sure. Now whether it comes back 6 months later, 12 months later, because no longer you can, you cannot for a long sort of ignore an economy which is growing fastest in the world, a democratic setup, youngest country, corporate earnings growing at 15%, ROE 15%, cannot ignore. And valuations have corrected. So it will come back. Now, whether it comes back 6 months later, 12 months later, I don't know. From a long-term investor perspective, I always think that it is better that it comes later, because then your domestic investors are getting to put money at a reasonable valuation.
Okay, so all of these factors are working very well for the domestic structural story of India and domestic investors. There is this consensus that small caps are offering an attractive risk-reward play because for 2 consecutive years there can't be a fall. What does one do with small caps? Do you now shift positions into small caps more than large caps? What are you saying?
So we don't, to be very frank, our investing style is very different. We have more bottom-up, more stock specific story. We say if we like the business and the management, we would rather buy it small. So, but having said that, of course, last 2 years, a lot of corrections have happened. Froth has got cleared in many small and mid cap. Many good quality companies have corrected 40-50%. So they have come in the buying range. So we've been kind of, wherever we have that comfort, we've been buying. So I would say that rather than looking at only cap, look at investing more from a point of view of business and management. Of course, naturally, small and mid cap, given the growth over a long period of time, tend to do better and outperform. But it has more volatility risk. When the markets go up and down, small cap and mid cap tends to be more volatile than large cap. So if volatility risk worries you, don't buy small and mid cap. But if it doesn't worry you, then I think small and mid caps are much better.
Okay, so volatility risk is a big part of the game when you're investing in the small caps. Yeah.
Yes.
So let's talk individual stocks. Are you okay with that?
I would avoid that.
Okay, fine. I wanted to understand, you touched upon the pharma space as a whole. A lot of these Indian players are now very well positioned to benefit from the structural shift that we are seeing within the space. There's managing costs, diversifying their supply chains. Which kind of companies stand to benefit, and are you not worried about expensive valuations within pharma?
No, I don't think pharmas are very expensive, to be very frank. In fact, in last few years, some of them have done well, but they are neither cheap nor very expensive. But good news is that the international, domestic pharma was always doing very well. Domestic formulations business, the generic business abroad is picking up. Pricing pressures have come down. So I think again, you have to, in pharma also, you can't broad brush. You have to see the company specific.
Yeah.
Because each company has a very different, unique business model sometimes. So we've been in the biosimilar space. We've been in some of the generic pharma companies. We've been in some of the CDMO companies. Yeah. So you got to do, and you can't really value a company in only based on the PE of the current year, right? I remember, Loras, we've been one of the, large holder for quite some time, as is public knowledge. At one point in time, what was looking at 50p, suddenly in a year's time becomes 30p, right? So the earning tends to be very, very, non-linear in that sense.
So, what does your checklist look like, Vikas, when you are assessing a particular company? Say you found the sector looking attractive, then what does your checklist look like? What has to meet your criteria?
So first of all, I think for us, very, very important, the management quality. What is the broadly we look at three things in management: competence, integrity, and drive. You have competence, no integrity, we will not make money. You have competence, integrity, no drive, business will not grow. You need hunger. You have hunger, you have integrity but no competence, competition will eat your life. So you need to see combination of these three things for you to see that this company, this management team can deliver, right? Of course, you need to also understand business model, because without a robust business model, even a good management will not be able to kind of deliver well. Yeah. Like for example, just to give an example, like we historically never invested into microfinance business because structurally it's a weak business. Now, even if I put a good quality management in a structurally weak business, it ain't likely to deliver you very well. So you got to see the business model. What is the inherent strength of the business model? What is the competitive advantage? What is the moat in this business? All those things you have to see, right? How much is the sort of gross margin, cushioning of the ROE profile, cash flow profile? All those things you have to see whether it makes sense. Is it a good business? And finally, it boils down to seeing the valuation, right? But more importantly, valuation is a very is an art than really a science. But other thing which we generally see, that what do we know, what advantage we have over the market? Because today's time and age, everybody knows the same thing, right?
Yeah.
Management does con calls, there's a full disclosure, right? So for you to have come out as a winner than others, you have to have some extra perspective, extra advantage, right? And that is what we try to build. We do an in-depth research that deep dive in terms of when for example, since we spoke about Loras, which has been one of a large position, everybody was kind of writing them off. Stock fell from 700 to 300 rupees, and when we were doing our work, we were very convinced about the competence, the capability part they know, right? The management integrity, we kind of very, very, very confident about, right? So, and of course, very, very hungry and driven management. They want to build a very large company, ability to take difficult calls, even if there's a lot of pressure on them, right? Those are the kind of qualities stood out. And when we did our work, we felt that, yes, they have disappointed for 2 quarters, but that does not mean that will go on forever. But everybody was judging them based on 2 quarters. Like in the case of market, today if you judge India by current situation, you will obviously, come out negative. But if you see what is the overall India potential, like you asked me, you generally remain structurally bullish on India, because I believe that, it's a structural story. Yeah. So if you believe that is part of the company management and all those things, then, your that extra advantage is your perspective that, look, on the other side, it will come out well and deliver returns. And then when everybody gets comfortable, then you don't get that price, right? And today the stock is 1,200 rupees in less than 2-3 years time, and everybody wants to buy that because now there's a lot of comfort. Yes. So you got to have some extra edge, extra advantage over rest of the market is where we believe, there's a serious alpha to be created.
Speaking of this extra edge, would you say that it was the case with one of the large cap banking stocks as well, one of the most hated banking stocks, that you had the conviction, or, the company had the conviction to invest into at the time? What was the thinking behind that? Was it a tough call to make?
Actually, it was not a tough call to make, but it's just that our work which gave us a lot of conviction, right? When everybody was, not comfortable, we could see a change happening in the bank. We could see that a lot of change from a dejected, demotivated bank and team. Suddenly there's energy, suddenly there's a drive to achieve and grow and put past behind, and when that happens, ultimately growth answers all the problems.
See, but there's a very fine line, Vikas, because there are a lot of those, say, penny stocks or small cap companies that had their glory days, and then the fall has been relentless. And then to bet on that, you might just burn your fingers. But when you are saying that you see that change or that drive to alter, what is the difference? How are you differentiating, a good company from one that could continue to face bad times?
So look, again, I'm not talking about contra investing. Contra investing believes in it's cheap, hence someday it will turn around and it will
Okay.
do well. I'm not. So when you don't buy anything because it is hated and because it is there are lots of stock which are hated, probably will remain hated forever kind
Yeah.
of thing, right? What we look for is a catalyst. What is changing? What is changing from yesterday, either positively or negatively. If it is changing positively, then there is opportunity to make money. If they are changing negatively, if you have that stock, sell it or short it if you are able to, or if that's your strategy, right? So always I believe that, as one of the, I say this, often that one of my biggest learning has been as a an investor is that focus on rate of change.
Yeah.
What is changing positively or negatively, and if you are able to figure out that change ahead of others, you have winner sitting on you, or you have a source of alpha.
Okay.
Now, how often one can tap that, capture that, depends on the setup one has.
So, management quality, the business model, valuation, and of course, having an edge. That's the criteria that you look at. What about this IT sector? Because we are seeing this huge change now taking place, and we have seen every technological transition that has, sort of benefited the space as a whole. In India, do we have the sort of the giants who are not adapting as quickly as they should, or is it just a matter of time?
No, it's a matter of time. See, again, we have to give credit to Indian IT services industry that, from Y2K when it was only a $10 billion industry, from there today they have, gone to $240 to $50 billion. So, that time a lot of people wrote off IT industry. So they have survived and thrived in many technological transitions. So does not mean that every same company will thrive but industry will thrive. Either same player or some new players will come. For example, in 2000 cycle, Infosys, Wipro, Satyam were the ones which got created. In 2009-8 post-global financial crisis, you saw players like Mindtree, HCL Tech, LTTI, LTTS, Persistent. All those companies got created and got size and scale, right? So every time there is a technology transition happens, new company comes, gets scaled up, and I'm sure this will also happen this time as well. Some will not adapt, some will adapt, but the sector will grow because no matter what happens in technology, you don't spend less on technology. You always spend more on technology.
Yeah.
Right? I don't know anybody who's spending less on tech. So,
But will it be the mid-sized companies that will maybe?
more likely.
Okay.
I mean, jury is still out, and that's a part of the research we have to keep looking for, but more likely.
Okay. What about the order books, the execution capabilities of the entire manufacturing and capital goods space? Is that something that interests you?
Of course, we've been very, very, we have a manufacturing fund which we launched in October 2020, 6 months after pandemic. Yeah. So we were one of the, very early voice on, in coming conviction and manufacturing, and that remains a decadal story. In fact, current currency depreciation only helps in that sense manufacturing case, because both for import substitution as well as export, right? So, we believe in this whole pack. Within manufacturing, you can look at auto components, specialty chemical, capital goods, defense, EMS. I mean, the entire basket where either you are focusing on import substitution or export-oriented stories. So, we've been very, very positive on that.
Okay. Vikas, I want to move to the larger picture because you have spoken in the past how this power shift, it's very slow, it's very gradual, and we're seeing the dynamic of the world changing. Do you think that there is this fear of the world order now changing completely, moving from the US to China? Is that or is there nothing to it?
No, there is, see, the whole fight is about that, right? I mean, we have seen in the world, globally, historically, every 100, 150 years, power transition happens to we've seen that from, how it has moved from Dutch to Spanish to, British to US. And over the years, Portuguese were there earlier. So we've seen that transitioning, right? And today, that same tug-of-war is happening between China and US. Now, only time will say that who is the winner out of that, right? Because these adjustments don't happen overnight.
Yeah.
They take decades to happen, right? Of course, right now, the current the conflicts are also a result of that, whether it was Ukraine or Iran, because before these adjustments do happen, a lot of conflicts happen. There was a time when it was between US and USSR, and USSR got dismantled, and so US won in that point in time. But there was that time. So now in this, who comes out, nobody knows. US is a bit vulnerable on their economic front, on their but they have reserve currency. They are democracy. So, and they're also kind of vulnerable according to me. They have kind of they've broken up with most of the world. I think
Yeah.
the trust in the US system has kind of got lost with this recent developments of last 12 months specifically. Whereas China is, it is non-democratic country, but it has a lot of other advantage. It has. So I think one does not know, and nobody will know. I think it's only time can tell you that. But yes, world will remain till the time that clarity comes. It will remain vulnerable, chaotic, volatile, and you will have to deal with it.
Just take it in your stride. Yeah.
You have to deal with
Yeah.
it.
But it's interesting that I read this article from Ruchir Sharma who said, just like you were talking about the US, so much has changed. We bash all day, but still global investors are buying all night. Why do you think that is?
Because that's the only market where a lot of money can be absorbed. Technology is happening. Today, China technology is happening, but people can't put money there.
Yeah.
Right? I mean, North, on all said and done, US has taken lead in technology historically for last 10, 20, 30 years. And it has ability to absorb capital. It has democracy. It is a free capital move in and out. There is no other market of that kind of size, space, and everything else, right? Only the China is contented, but China is not free economy. So, and plus US, of course, still controls fairly large part of the global tech ecosystem. So that's there, but of course, that's the reason today US market cap as a percent of the world market cap is almost close to 2/3, which is itself is a big risk, right? So now whether it continues to remain there, it will change. Time will say, but I think there's a very odds are against of US ability to maintain 2/3 of the world market cap. It has to kind of change. It has historically not remained. But again, these are the things you don't get answers in a month, in a quarter. They will prolong and suddenly it will happen.
And what's your view on Indians having global exposure? How integral is it in their portfolio?
In fact, today our letter is coming out only on that part.
Okay.
We've written that, that why should you do it? Should you really do diversification? Is it really needed? What's the purpose of it? What's the role of it and all? And it is very interesting that, very often, and we have given a table in our letter saying that if you look at last 1 year's return, it tells you a very different story versus your last 20 years return. So if you're deciding looking at the last 1 year's return, probably you must diversify and everything else looks good and India looks bad. But if you look at last 20 years, India is the best performing emerging market over last 20 years in dollar terms. India is the only market which has done well, very close to US market in dollar terms. Difference between 20-25 years number. I'm not talking about some short period, right? 10 year, 20 year, 25 years number. So if you have, that kind of history, in that period, I'm sure in that journey, there will be many years which India will not do well. And that happens in case of a stock, that happens in the case of sector, that happens in the case of a country. So last 1 year has been very rough for India. But if you see 3 years before that, India was very good. As compared to those markets, China was not. People started talking about China in 2017 when it was cheap. But 2017 to 24, it remained cheap. It didn't give any return, but India did very well in that period. So I'm saying there will always be periods. You have to know why you need diversification.
So do you believe you need it or not?
So I'm saying it depends on if I have some, let's say liability, forex liability, you might need it. If I have some, objective to achieve, you might need it.
No, say I'm just an average investor looking to...
You don't need it. According to me, you don't need it because you are able to achieve a similar objective, by remaining invested into India.
You don't think that now we're leading more global lives, that in general we need to have that kind of exposure given the vulnerabilities of the Indian market and what may happen? Don't put all your eggs in one basket.
That's what I'm saying, that you are deciding Indian vulnerability today looking only, a very short-term period, right? But if you look, this vulnerability also strength, I'm saying like, if you look at India 3, 4, 5 years perspective, two years ago, this conversation would have been very different, right? That time India probably was looking very, so I'm saying very often the recency bias is always at a play. What happened recently only we believe that will continue to happen. I continue to have the conviction that India is one of the best story around the globe. We are the youngest country. 2/3 of our population is working age population. Nowhere in the world is happening. We are progressing on all counts. It might be slow, but no country gets built, including US. US is a 200-year-old democracy, right? Their technology investment started 50 years ago. Ours started only in 10 years. So I think it's a journey. India is on repair. India is on build out. And if you believe in that, you will remain invested. At least I do believe, and hence I am always invested.
Yeah, clearly the fact that you have given us that headline that India is one of the best stories now. I want to move on and talk a little bit about gold and silver. I know you are no expert, but their performances are in bursts. Do you believe that the best part of the rally is now behind us?
I think so.
Okay.
Again, like I take my view with a pinch of salt, but it always move in a step function. There's a period of no return and period of fast return. So if you already missed it, I think this year I don't think has been good for it. So last year it was good, but most people end up buying after the returns have been done because again recency effect. So a lot of people bought gold last year at almost close to the peak and now are suffering, right? Same thing you can apply to other emerging market versus India argument.
Okay. I want to understand a little bit more about you on the personal side. The fact that you began your journey in the stock markets at a time when things were very different, the Harshad Mehta time, and we did see that IPO boom. You have admitted to have even lost your father's money. Can you tell us a little bit more about that?
Oh. No, I think so. Like every young, you want to get rich fast, and Harshad Mehta boom caught on everybody. So I used to invest into IPOs. I had no clue how to evaluate. Read newspapers, and no clue, absolutely no.
It was more just tips and things. Like
yeah,
that?
I mean those days, one newspaper used to come with whether to subscribe or not subscribe, kind of recommendations and all those things. So yeah. So, but you did not know investing. Forget why to blame anybody. I did not know investing, and that's where you make all the blunders, and that's where everybody makes that blunder, I think.
So what blunders did you make? What did they teach you?
I mean, I lost pretty much the entire capital, right? And then it was a setback, and then I had to say, let me learn. And so I decided to complete my professional degree and then work for some years before I could, plunge into it. And so basically then started focusing on building, confidence building, capital building, knowledge. Only when you build all these three, then you can think of coming back. So I invested a lot of years in this before I could even take a serious plunge.
Yeah, and that clearly has stood you in good stead. But Vikas, apart from obviously everything that you've read and learned and the data, the emotional quotient plays a big role while investing in the markets. What advice do you have for people when it comes to the EQ?
So I think, you have to know what you're doing. You have to keep, very often I see investors panicking out when markets don't work that way, their way, and, very often start being skeptical about things. A bad experience will always create a scar which will last forever, and then so I always say we experience will teach us a lot of things, but build experience, not scars. When you build scars, they will last forever, but when you build experience, you will learn from each experience, right? So how you take a setback as a learning or as a permanent this thing, and that's a very big thing. So I think, and I see very often people are not able to remain calm and composed when things don't go right. Today, a lot of people, are only sort of speaking negative, and so there is a patch. So I always say that don't lose woods for the trees, and you have to keep your mind very, very calm. You have to know what you're doing. You have to keep very long term. You don't have to be in a hurry. So all those things, balancing figure are very, very balancing, keeping your mind balanced is very, very, very important. And we all know from experience and learning that investing is more about behavioral than actually, more science. Science part everybody can learn, and I think most successful investors have got the behavioral part right.
So how do you maintain that? Do you have any practices to keep your mind balanced, especially in tough times in the markets? Any daily practices you follow?
So I think I have said again publicly many times in the past that the meditation is the very big thing. I am a practitioner of Vipassana.
Oh my God, but how do you do it? I just don't understand. I mean, my mind is always racing.
That is why
you need it, I know.
You need it, right? So you go there, you will realize that once you do a 10-day program, then you do again. When you do it again, you do practice on a regular basis. It is not happening overnight. I think very often people make a mistake saying that I should just, I am sitting in meditation, my mind should quiet, and it doesn't happen. It takes years of practice. But more importantly, I think it allows you to have, balance in mind, equanimity, right? And secondly, I think, resilience is most important according to me. And I mean, that's probably God's grace. And, maybe I don't feel much let down by the setbacks. I mean, when the setback comes, you feel bad for a little bit, but then you start focusing what next I can do. So whenever you are faced with a problem or a challenge, rather than focusing on the problem, focus on the solution, that what is now, what is next, rather than, brooding over it and, sort of spoiling your mood, energy and time on that. what you can do about it and move on. So I think resilience is most important thing as an investor. Other thing which very often people say that I'm always optimist, right? I mean, optimism should not be misunderstood as a lack of risk consciousness. Being optimist always helps you to see things differently and constantly. Does not mean that you are ignoring risk.
Yeah.
But it allows you to kind of be at it. And in equity investing, you have to be optimist, according to me. If you are into credit business, you should, should be pessimist because you are all the time worrying about managing that risk. But equity business is all about optimism.
So you need to be an optimist to be invested. Yes. Yeah. What about your relationship with money? Would you describe yourself as a frugal person? What about this hedonic treadmill? The fact that we just keep wanting more and more. How do you explain your relationship?
Yes, I think it has gone a significant change. I mean, there was a time when I used to chase money, making money fast and quick was my only game in time. Then it became playing game right way, and some point time it flipped that if you do right things, money will come. I'm still a frugal person. I'm not splurging kind, but yes, earlier I used to be very stingy, which has changed to become so, and that again to do with your upbringing and background and stuff like that. But yeah, still I'm not splurging. To me, money is more as a means. Of course, it is very, very important, but growing it is a big fun and game. Knowing very well that you will not use it. Knowing very well that knowing my lifestyle is my mental. I will never.
Yeah.
I would rather use it for wider purpose or doing a broader good. But I think that, and it changes for most people. I don't think I am only unique in that. It changes with the progress of time and size.
What advice are you giving your daughters when it comes to their relationship with money? They're of course growing up a lot more privileged than you did. It's so difficult to balance that because you can't ignore that and yet you want to instill values. And what are you teaching them about investing?
So I think again we chat a lot about it very often in us, in our family conversations. Of course, they are privileged than like you rightly said, than us. So I think we again don't live and I think in my opinion, no matter what you say to them, how you live is the biggest communication you can give them. So I don't think we show off money. I don't think we ourselves are splurging and showing levies, throwing our wealth, showing off wealth. So if we don't do that, I'm sure they will also. We in our conversation we always talk about how to manage within your means and stuff like that. So
actions speak louder.
Actions speak louder than advice. No matter what you tell them, they will see you and learn from you. And to my mind, yes, you can share experiences. I like to tell them stories of the businesses that look how this person came from where he built this company. If I'm at an exciting company, if I'm investing into some company, I share with them stories so that they can relate to those aspirations, that what are the potential, right? I share stories that this person was given this platform, he took to 10x versus somebody who was given a platform, he squandered it. And very often my elder daughter will ask why this person lost out everything, and when I am saying that he had a lot of loans, he said, there you go. Every time leverage is the cause of a biggest problem. She started telling me this.
Wow, so she's teaching you now?
She's figuring out that every time leverage is the biggest cause of everything else, right? So I mean, they will pick up from the conversations. I mean, I don't specifically target, this is what I will teach. I generally kind of have conversations.
Okay, that's interesting. Let's get into a quick rapid fire before we let you go. Nifty at the end of 2026, 25K or below?
Anybody's guess. It's a lot dependent on the. Depends on, you tell me when war is getting over, I'll tell you.
Good one. Okay, one sector you'd put your entire personal portfolio into right now.
I would not
or
put
just
one
which
sector.
You have a lot of conviction.
Like I said, that BFSI and CDMO, healthcare, pharma, that bucket is a very large exposure we have. So. Yeah.
Okay. One investor, dead or alive, that you would want to have spend the day with and pick their brain?
I mean, I had fortunate to, not to spend time with late Rakesh Jhunjhunwala, so I think I learned a lot from him. Okay. But there are so many of them, I would love to spend, I would have loved to spend a day, he's no more there, but Charlie Munger, he's to me is a very wise person, more than an investor, I think is a very life-wise person. And I have personally learned a lot by reading his books. So I would have loved to spend time with him.
A book that changed your view on life or investing? Anything?
On life, I think there was a book I read by Daniel Goleman, Emotional Intelligence.
Okay.
That was a long time ago. In the recent times, I read a book by on Gita by Vinoba Bhave, and both of them had a deep impact on me.
The biggest misconception people have about you as an investor?
That I'm always optimist and I don't see risk.
Okay. Any regrets you have on investing?
I mean, look, you always learn from mistakes. I mean, I wish I had the proper knowledge guidance. I mean, it's not a regret, but I wish I had that proper knowledge guidance in early part of my career.
Yeah, when you began.
When it began, and even early part of, I had to kind of, but again, no regret. Life has its own plan.
It taught you so much.
It taught
so,
me, yeah. So,
Vipassana or a beach vacation, what resets you more?
Both have different outcome. I think I would love to do. I love both. So
Your daughters will say beach vacation.
yes, my daughter loves beaches.
Yeah.
So she loves beaches, and we go most beaches doing scuba diving and all those
fun.
things. Yeah.
Okay, great.
But with family for sure, beach vacation. By myself, Vipassana.
Vikas, it's been such a pleasure interacting with you. Thank you so much for joining us today.
Thank you. Pleasure. Lovely chatting with you.
So many key takeaways from that interview with Vikas Khemani. He spoke about how the short-term bumps in the market should not alter one's long-term view. He continues to believe that while India is vulnerable, particularly on the forex front, the structural story continues to remain strong. If you're looking to invest in small caps, do remember you need to have the risk appetite for it. Management quality, business model, valuations, and that extra edge, that's what he looks for when entering a sector or a stock. He believes that India still remains the best story among the globe and believes that one really needs to maintain a balance and focus on solutions rather than finding the problems. That's his view on investing. I hope you enjoyed the interview. Do remember to like, share, comment, and of course, subscribe to the YouTube channel. Thanks so much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.